Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Matteo Binfarè. Matteo is a professor at the University of Missouri. He studies, researches, and teaches investments, pensions, endowments, and decentralized finance. Matteo and I had a wonderful conversation today where we really focused on decentralized finance, the state of affairs, cryptocurrency, and whether it deserves its own asset class, whether or not cryptocurrency deserves a place in most people's portfolios, how much you might consider allocating to it if it does, and some of the important risks you need to consider if you're considering investing in cryptocurrencies. There's a whole lot of information about cryptocurrencies out there in the internet today, and if you YouTube or Google the word cryptocurrency, you're going to have no shortage of videos to watch. I really enjoy talking to academics about decentralized finance and cryptocurrency because these guys are grounded in the scientific method and prudent research practices. Whereas a lot of the stuff you're going to see on the internet and on YouTube come from crypto bros who just kind of talk from their hip without a whole lot of substance. We had a great conversation today, and I hope you enjoy it too. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms, and before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. Matteo, welcome to the podcast.
Thank you, Grant. Thanks for having me.
I appreciate you being here. I'm really excited to talk about decentralized finance. Why don't you share a little bit about what decentralized finance is and the state of decentralized finance today to get us going?
Yes, sure. Thank you. So, to kind of learn about decentralized finance and understand what it is, we need to think a little bit about centralized finance first, right? So that's the world we live in currently. So, we, for example, need to make payments. When we think about industries with a lot of intermediaries, the first one we think of is finance, right? The second one is probably healthcare. But finance is definitely the industry with the most level of intermediation. And that's where DeFi comes in, try to disrupt intermediation and make finance decentralized. Okay. The key here to understand is that whenever we want to make a payment, for example, I want to send money to you, it's pretty straightforward if we are at the same bank, right? That's because the bank will pay you $10. The bank will subtract $10 from me, will add it to you. Nothing happens. You have more money, I have less money. The bank is in balance, and that's it. Things become problematic and kind of costly, time-consuming as well when you send money to a different bank. So in that case, you need corresponding bank. You need reserve with the central bank, the Federal Reserve, clearing banks. This becomes even more problematic when you do cross-border transactions, right? And the main problem here is that it's costly. It takes a lot of time. But obviously the system is there to last. The banks obviously don't want to be disrupted because obviously they make money out of the intermediation process. But decentralized finance comes in and try to solve many of the problems that that we're stuck with centralized finance. Again, I'm not saying centralized finance is bad or evil, but definitely decentralization, DeFi, the goal at least is to, increase financial inclusion, for example. And we can talk more about all these issues. But, as someone that came to the United States, there are many issues with the current financial system. For example, I wanted to, bring money from Italy when I moved here for my PhD, and it was a pain. because it takes lots of fees, lots of time to get money here. I needed to start my PhD life and my life here in the US. That was really, really painful. No credit score, although I've been working in investment banking in Italy for quite a while, and I had money saved in Italy. No credit score in the US, so no credit card, and that's painful. And that's it's in my experience, but it's can be applied, for example, in emerging economies, right? And that's, I think, the role of DeFi is to basically crash those costs, make it more efficient, decentralized, no need for intermediaries, and hopefully improve financial inclusion around the world.
Yeah, that's a really good description. And in the past, in past podcast episodes, the way I've described it is, from my perspective, it is clearly a far more efficient way to transact money around the world. And you gave the example of when you came over from Italy, you didn't have a credit score, it was expensive, it was challenging, it was a nuisance. There are there are millions of people in the world who leave a third world country where they grew up and were raised to work in a more developed country and want to send back money to their family members. And you have all these international transaction costs, and it's just a huge problem. And so I completely get what you're throwing down there about decentralized finance being a system that's more inclusive. There are millions and millions of non-banked people out there. It's clearly more effective. Now, the other benefit that a lot of people flock to is that decentralized obviously is the opposite of centralized currency. And if you're someone out there who's concerned about the level of federal debt that we have in the US, the fact that the US dollar is the world's reserve currency and it's controlled by a government that runs really heavy deficits and a lot of debt, perhaps holding cryptocurrency that is not subject to any of those influences could be an appealing alternative.
Mm-hmm.
What are your thoughts on that benefit?
Yeah, no, I mean, it's definitely, the crypto world changes every second. So it's really hard to keep track of what's going on, especially now that I think the, governments, SEC, everyone is looking into regulating crypto. So I think we need to understand there's some confusion, I think, in what crypto really is. People think about it as a new asset class, but it's really not. Because it's like, it would be the same as, I'm from the 80s, so I was around when the internet in the 90s, you start, plugging your internet cable in and you will hear that noise to connect.
The screeching modem sound.
Exactly, the modem sound. Now we, so I lived around that time. But crypto, it's mostly like the internet companies of the late 90s, right? So it's not a different asset class, it's just a different technology. So people think now about like Web 3.0, right? So I think there's governments, whether you use crypto as a medium of exchange, as a store of value, it is really a store of value, maybe not, could be a medium of exchange. But I think regulation, at least in the US, will have to help foster this technology, right? It can't just crush it because that's just innovation. Obviously, the problem here, I think, is more with the know your customer. That's, I think, where the regulation is mostly concerned. Whether you have crypto on one side, you have the dollar on the other side, but at least any transaction that is made out in dollar and it's regulated, people like us are protected. If my grandma sends crypto and gets hacked, she loses all her money, right? And there's no way you can get it back. So I think the regulation will kind of strike a balance, because between allowing crypto to some extent and maybe central bank digital currencies like digital dollars, and there have been talks about that. I think the Boston Fed and MIT were trying to kind of launch a trial for that digital currencies.
So from your perspective, you're not seeing crypto as any kind of newfangled asset class that is strikingly different from all the existing asset classes. How do you reconcile that concept with the idea that this new technology does behave differently than existing assets and the intrinsic benefits of everything that we just described, the ease of transacting? We have Bitcoin with the biggest brand equity, name brand, and interest and appeal these days. That has some value because Bitcoin is decentralized in and of itself and fits that bill, but it's not an asset class. How do you reconcile those two things?
Yeah, I think we need to be careful when we say asset class. Again, I don't think it's a new asset class. From a purely financial standpoint, I mean, if you look at the last year or so, the correlation with US equity, Bitcoin US equity is 85-90%, right? So again, is it a commodity? Is it a currency? Right?
And what you mean there is we have a lot of listeners who are really financially savvy and probably are following along really well, and some that are less so. And what you're saying is that the value of Bitcoin tracks pretty closely to the broad equity market. There's not a whole lot of difference, right? Your
Yes.
correlation is
So
85 to 90%.
exactly, especially over the last 12 months or so.
Yeah.
So if you look at Bitcoin, or if you look at crypto in general, Ethereum, Solana, Cardano, all those other blockchain and cryptos, the correlation, so the co-movement with the U.S. stock market is pretty high. And I hear a lot of people saying, crypto Bitcoin is a store of value, it protects against inflation, but does it really do that? Gold might do that. In fact, correlation with the U.S. is, it's very low, and has been a store of value over time. Again, if you look for the last 10, 12 years of Bitcoin, or the only 12 years of Bitcoin life, obviously you see that it's been going up, from $1 to 45,000, right? So if you look back, it's probably it was a good investment, right? But it's when you need it the most to be uncorrelated with the stock market that it seems like it's not doing that. For example, inflation is coming up high, 7.5%. There was a bit of a sell-off in Bitcoin as well, then kind of recovered. So I don't know. I wouldn't consider it a new asset class. You have to, I think more similar to what we've done in the 90s. You wouldn't say internet companies were a different asset class, right? But Web 3.0 and blockchain will be the same idea that we had when we had internet, and we didn't have anything like that before the 90s.
Right.
Like the .com. But I think the key difference would be, and we can discuss that more, will be, I think, the role of the customer in this new world of blockchain. That I think changes completely compared to what we had before.
I'd love to dive into that in just a moment. Could you also, for our listeners, describe what you mean when you say Web 3.0?
So yeah, exactly. Web 3.0. So if you think about the original internet, right, in the 90s, was basically you log in, you surf the internet, you go on a website, you do your things, you buy, etc. Right? Then you got Web 2.0, which I think is basically the internet companies. Every company in the US is an internet company. Everything can be considered as an internet company. That's why we don't have to think about Bitcoin or blockchain as a new asset class, because everybody will be a blockchain company at some point in the next 10 years. And Web 2.0 is basically these companies have left the consumer, with a click buy a stock, right, on our mobile phone. So that's kind of mobile cloud. Web 3.0 is when our data is in our hands. Okay, so we are the owner of our data, and we, in a decentralized cloud, can decide what to do with that. And that's that's allowed because of tokenization, because we have tokens, so we can actually participate as customers, we can actually participate into the protocol, rather than being, Facebook is free, right? But there's a reason why it's free. Facebook and Instagram are free because we are the product,
Right.
because they use our data. But in Web 3.0, we decide whether we have to pay for a service. We will have to pay probably with a token to use the service, like when you use Ethereum to pay for gas fees. When you have to use Ethereum to use an app on Ethereum, you pay gas fees, and that will be the same. But then we own our data; we cannot be tracked unless we say so to the decentralized platform.
And the whole key there is use of the blockchain, which enables us to tokenize our own data and have more discretion over when and how we're using it.
Mm-hmm, exactly. And I think that's what makes Web 1.0, 2.0, 3.0 so different. I think, from the 90s to today, 2021 or before blockchain became mainstream or will become mainstream, the internet companies, fintech, were just trying to push, the limit of customers and product use for us to make it simple, with an interface, a simple app. The problem is that, especially in the financial system, in the healthcare system, in the education system, is the back office that is still the same as it was 50 years ago. That's why, and going back to DeFi, decentralized finance is important because it makes the back end, the back office, fast, and that will crush costs. And that, as you mentioned, there's many unbanked. Transaction costs are high, and these will be a way to, because you're on the blockchain, everything is verifiable. You don't need intermediaries. The cost can be crushed, and then people that cannot afford a mortgage now can, right? People that couldn't borrow now can, because everything is on the blockchain. The costs are low. There's no intermediation. There's no audit to be done. Your FICO score is on the blockchain, and everybody knows it. So I think that's the best way to describe Web 3.0 and the role of decentralization and DeFi here, is that you don't have to be maybe long crypto, right? You don't have to own crypto to some extent. And some of the applications today, I think they don't really fulfill their mission, saying that, we're solving the unbanked problem or the access to finance problem. Many of the DeFi applications today are indeed only for people that own crypto. So it's kind of like a vicious circle. But there are a lot of, I think, applications that will crush costs and will help the unbanked get access to finance and finance their project, for example.
Yeah, absolutely. So do you think it's so those kinds of applications there's more intrinsic value to those kinds of applications when we're talking about decentralized finance than just the pure appeal of, I'm really upset with the government for running huge deficits and I'm concerned that the value of the dollar is going to crash. Therefore, I want something that's not influenced by those motives. Is that fair? I mean, how much am I overstating this influence?
No, it's fair. It's fair. In fact, you see that, the value of the dollar, if you think about the value of the dollar over the last 150 years, I think it lost 80% of value, right?
Yeah. But to be fair, all currencies are devalued over time. That's just the long-term debt cycle. That's just how it works, right?
Yeah, obviously, supply is potentially infinite, right? Unlimited. Right. And we've known after the financial crisis of 2008 that you have QE and you print money, and then supply of money is like just huge, right?
Right.
But I think the main problem is not, or the main issue we need to discuss is not in the US. I think it's mostly around the world in developed nations, right? That's where you see adoption of Bitcoin, El Salvador, right?
I was going to ask you about that. Yeah.
Exactly, El Salvador, which, only time will tell if it was a good decision. We're not here to speculate, I guess, but you see more of those countries adopting, or at least making Bitcoin more mainstream for the retail people like us.
Sure.
And obviously, you can see other cases, Venezuela, hyperinflation. Maybe Bitcoin would have been a good strategy. But we're still at the very beginning of this, so we can't really say with certainty whether it's a good idea or not.
Sure. And just to slow things down for a moment for our listeners out there who are wondering what the heck we're talking about, El Salvador here, maybe 6 months ago, announced that they were going to accept Bitcoin as legal tender, meaning you can pay your taxes in Bitcoin. They even provided a quote unquote wallet available to their citizens and put $20 or so worth of Bitcoin in these wallets. And since then, they've been using government coffers to buy Bitcoin, add them to the government's balance sheet, which is a really interesting move. It's a really aggressive move by a young, aggressive politician over there. But what Matteo is asking, which is, I think, the right question, is would something like that have helped in really inflationary environments like what Venezuela is going through? And for these developing economies, if you want to develop your economy and go out and borrow money to build infrastructure or anything like that, usually you're going to have to do it in another currency, which provides a whole lot of risk, and it's a slippery slope into one of these inflationary environments. But through the advent or maybe use of Bitcoin or another token or coin that's not centralized, perhaps it's far easier to provide that kind of price stability.
No, I agree. I mean, I think you kind of touch on all the good points.
It could also go to zero. That's the bad side of it.
It can also go to zero. I think it's hard to think about the problem when you have a government that kind of acts as an hedge fund. Because you said buying Bitcoin when there was like a minus 20% return at some point a few months ago, buying more, and then it's kind of the government gets involved into people's life too much, and you're kind of playing with people's lives here, right? Because if now everybody has exchanged their currency for Bitcoin, and what if that goes to zero?
Can you think of any other examples historically where a government has acted so aggressively with their own currency? And I like the way you put it, acted as a hedge fund. Or is there precedent for that historically?
I'm not sure historically. Yeah, I'm not completely sure. I mean, there's definitely be strategic devaluation over time. Especially currencies they used to be pegged to the U.S. dollars. And countries have done that in the last 100 years or 50 years after I guess Bretton Woods, after the and after the U.S. dollars wasn't pegged to gold anymore.
Yep.
But I mean, also the U.S. has done it with gold, right?
Sure.
Because after World War II, the U.S. government, were the U.S. dollar was linked to gold, and everything else was pegged to U.S. dollar. But there was definitely room for some kind of manipulations there.
Sure, absolutely. But there's precedent for that. I mean, there had been fiat currencies before that point in the world that were previously linked to gold and went purely fiat with no exchange at that point, right?
Yeah, exactly.
So we talked about a lot of the benefits and potential technological innovations and improvements, particularly on the banking system. Tell us a little bit about smart contracts. This is something, and you mentioned the crushing of fees across all sorts of industries. One example that I mentioned on the podcast that you touched on was in real estate. If you're going to buy a house, you have to go through a title company. A smart contract has the possibility of just taking that cost out of the equation entirely. Could you describe what that is and what the potential use case and benefit is?
Yes. So a smart contract, I think it's really easy to understand if you think about this simple example of a vending machine. Okay, so a vending machine, right? You put coins in there. You select that you want a Kit Kat, and if you put enough money, the vending machine will automatically, give you your candy bar. And if anything, we'll give you also some change, right, if you put more. A smart contract is exactly the same. It's a piece of code that automatically perform a task, right? So you don't need anyone to tell you whether you're right or wrong, because it's just coded, and it's completely verifiable by other parties in the protocol. So we all agree that the code should perform what is coded for, and that simplifies things because one clear example is insurance for flights, right? When you fly and you buy insurance, well, we never really read the fine prints, right? And what happens if your flight gets canceled? What happens if it's delayed? Do we pay you back? Do we not pay you back? So a lot of people buy insurance on flights, but then they really never use it, right? Unless there's like a delay of 5 days, that's kind of unbearable. But with a smart contract, if you trust the system, that's automatically that will automatically go through, right? So it will simplify things quite a bit. But I think with your example of real estate, I think you're right, because the level of intermediation, the title will be on the blockchain, right? So we don't need piece of paper. We don't need anyone doing the work behind the scene. We don't need an auditor that checks your FICO score or that you really own the real estate, because everything is verifiable by everybody, and that will crush the intermediation process. And hopefully the final consumer, so us, that we take on the mortgage, will benefit from a reduction in our monthly payments.
Yeah, that's clearly massively disruptive. The potential to be massively disruptive. How did you get interested in this kind of stuff? Could you share a little bit about your background? You're on the tenure track at the University of Missouri.
Mm-hmm.
You're in investment banking before that. Tell us a little bit about your background.
Yeah, so I'm originally from Italy, and I went to school there. Got my master's, undergrad, and master's in finance, and then I worked for about a year in investment banking, doing debt capital markets and structured finance. And then I realized that I didn't want to do that anymore, and I always liked teaching and learning new things. So I decided to apply for PhDs. I then got accepted to UNC Chapel Hill, and I got my PhD in finance. And 5 years later, I'm an assistant professor of finance at the University of Missouri, where I teach and do research. So I'm on a tenure track position, which means that I have to spend most of my time doing research, so writing papers and trying to publish those papers to get tenure. And then the rest of my time I spend teaching, which I love, and learning new things. And I got interested in crypto maybe a year and a half ago, and I started reading and researching and documenting myself, and trying to keep up with the fast pace of this new world, I guess.
I really enjoy having people from the academic world on the podcast, particularly on this crypto topic, because there are a lot of resources on decentralized finance and cryptocurrency available pretty much anywhere. If you Google or YouTube cryptocurrency, you're not going to run out of videos to watch. But a lot of them are from crypto bros kind of promoting their own stuff. And it's very refreshing to hear perspective from someone who's grounded in academics and research and the scientific method. And I really appreciate that you're interested in this stuff, because there are not that many professors around, I found, who are really studying it in depth.
No, I agree.
Go ahead.
No, I think it's right. I mean, I'm interested in crypto mostly for the underlying technology. Obviously, students ask me about what should I invest in, how does crypto play a role in my portfolio, and those are fair questions, right? But from my point of view, I'm really interested in the blockchain and in the technology that will allow things to innovate in the future. For example, another thing that I always mention in class when I talk about blockchain a little bit is think about when you graduate, right, and you want to have your diploma. That's painful, and that's another example. When I moved to Italy and the FICO score was painful, that's another painful story that you have to ask your institution to give you your transcript. It takes time. It takes weeks. You always have a PDF that is not shareable or only shareable once. You have to pay for it, but it's your diploma. You paid to go to college and to earn that diploma, right?
Yeah.
So with the blockchain, everything will be much simpler and cost free because that's your data, that's your diploma, and that will be on the blockchain, and it's easy to retrieve. Everybody can see it. They know you got your diploma, so it's not fraud, and will simplify things. So I think the underlying technology is what mostly interests me. And then being a finance professor, it's obviously allocating to crypto is a big part of the question that I get. Institutional investors getting into crypto. It's definitely an interesting topic. How much to allocate to crypto, the risk return profile of crypto. So these are all interesting questions, but I believe that the technology is what really matters here.
What did you not like about investment banking?
Well, the long hours.
Yeah.
For sure. I like my job before. I was in a great people. I learned a lot just in a brief period of time. Then I decided to quit and change career, I guess. Not completely because I'm still in finance, because I love finance. I love numbers and things like that. But yeah, definitely the long hours. That was unsustainable, I think. And I made the choice to quit when I had, at the right time.
Before you were worn down to a nub.
Exactly.
That's a good choice.
I still have a lot of friends back home. They all work in London, working 20 hours a day, 6 days a week, and asking myself, how do they do that?
Yeah. Not a solid quality of life. Working just for the paycheck is not that enjoyable long term. So back to some of the typical questions that you get. Tell us your thoughts about whether crypto deserves a place in your asset allocation. How much should you be thinking about allocating to crypto? And then secondarily, what are institutions doing? I keep hearing about institutions with a lot of cash on their balance sheets trying to leg into and allocate more to crypto. What's going on with all these things?
I think there's a place for crypto in your portfolio. That's for sure. What you often hear is allocate as much as you're willing and to lose. Okay, so if you can lose $5,000, and if you lose it tomorrow, obviously you're not happy, but you're not even I cannot make the end of the month. Then I think you should allocate $5,000 to crypto, right? Personally, I have 5% of my portfolio is in crypto, which is a decent amount, but not even too much. I wouldn't do more than that because, as you can see, the volatility is very high. So you can go from 100% gains in a month to back to where you started in a week. So put only, I think, what you are able to lose.
I like that that thought. And as a practitioner, we take all these concepts that you and I are talking about, and a big part of my job is communicating them in a way to our clients that resonates with them. And the soundbite that I often use when describing exactly what you're talking about is somebody asks whether they should be investing in crypto or not. One of the things we might say, circumstances depending, is if you have extra cash laying around that you don't mind taking out of the ATM, setting down in your driveway and setting fire to, that's the amount that you should probably put in crypto. And, it's a little, I don't know, tongue in cheek, I guess, but I I concur with exactly with what you're saying.
No, it's a great way to put it. And also,
And I'm going to use your vending machine analogy too. That's the best one I've heard about smart contracts.
and I think it's also useful to diversify within crypto, and that requires, I think, a little bit of research. And I try to read a little bit white papers if I understand them. Sometimes they're pretty easy to understand. Sometimes they're really technical. But I think crypto being so new, you should compare crypto to venture capital, right? Things that you don't really know whether they're worth 100 or zero. Some will go to 100, some will go to zero. Most of them will go to zero, but some will go to 100, right? So I think the team of developers behind any new project is what matters the most. Because it's really hard to value a company with a protocol in this sense with no cash flows, right?
Mm-hmm.
If you think the way we think in finance, value a stock, we take all the future cash flows that the stock is making, we discount that in the present, and we have a value. And you can do that with real estate, anything. You cannot really do that with crypto at this point, right? So I think looking at the white paper, looking at what the project is trying to solve that hasn't been solved from another project. For example, Ethereum 5 years ago, great because it was solving something that Bitcoin couldn't. Because Bitcoin was created, that's a feature of Bitcoin, created to be a medium of exchange and maybe a store of value using proof of work. So high energy intensive, but fully decentralized. Ethereum was just something different, right? Using a different consensus mechanism, but also fully scalable. So using smart contracts, etc. So what's the new one going to do? Go look at the developer. Go look at the white paper. What's new, or it's just really the same as Ethereum or Solana or Cardano. So I think that will allow people to diversify a little bit within the crypto space. And, besides being 100% in Bitcoin, right? At least you can put a few of your, allocate a little bit more to something else across 5, 6, 7 different cryptos.
So, and that's exactly something that I wanted to ask you about is the timeline here chronologically. Bitcoin was really the first mover advantage. Bitcoin has the most brand equity, if it's the most widely known cryptocurrency. And then you have Ethereum that came out after Bitcoin was created and improved on several of the deficiencies of Ethereum. Now we have these other coins, other tokens, other projects coming out all the time. There are probably, thousands of them in existence. A lot of them are complete BS and nonsense, but some of them are projects that have clear improvements and benefits from the original Bitcoin. Do you think any of these other coins with clear improvements on the original Bitcoin will ever actually displace Bitcoin? Because it's a hard thing to do, even if you have clear advantages.
I don't think Bitcoin will ever be displaced because I don't think it's a shortcoming of Bitcoin, the way Bitcoin was created that way. That was a feature of Satoshi Nakamoto's white paper to solve the double spending problem, right?
Yeah.
If you read the white paper, and that's, I think, one of the best white papers, it's so easy to understand. It's, 7, 8 pages, no technicality there.
Yeah.
And the idea was Bitcoin is a peer-to-peer cash electronic system, right? That allows people to transfer money without an intermediary. But how do we solve the double spending problem? Meaning that if I send you an email now, Grant, saying, oh, here's $5 digital, you can copy and paste that and send to your 10 friends. Nobody's there to check whether those $5 are one $5 bill, 2, 10. And Satoshi Nakamoto, solved that problem. Ethereum is just completely different. Ethereum is just a world computer, and kind of like a virtual machine.
Right.
So it's completely different to Bitcoin in user case and in I think utility, right? So I think Bitcoin will be around us forever, or for the time being at least.
That's interesting perspective, because the utility of each of these coins, each of these items is just different, but the use case is potentially vast and pervasive across industry. So adoption will absolutely grow across any number of these coins. And I like the way that you framed it. Familiarize yourself with each project, and if there's a clear use case for it, then industry will probably find it at some point, no?
Right, and it's like what was the hype in 2020? The hype in 2020 was DeFi, right? What was the hype in 2021? Well, it was mostly NFTs, right? Non-fungible tokens, so piece of art, music, etc. And now, what's the hype in 2022?
Web 3.0.
But there's many things that are going on, and that I think they have different use cases. For example, the metaverse, right? People are talking about the metaverse a lot, with Facebook, obviously.
Yeah.
Which is kind of scary, right? And that's
Scares me too.
That's kind of the dark side of the metaverse. Thinking about the new generation kind of going into these metaverse worlds. But if you think about things like Sandbox, I don't know if you ever heard about Sandbox for real estate.
No.
It's kind of like a protocol where you can buy virtual real estate, right? And that's all in the metaverse. But people are interested because it's scarce. A piece of land there, it's kind of scarce. Similar to Decentraland, you probably heard about that. You can go in the metaverse and buy on the blockchain and buy a piece of virtual land, or
right.
a piece of a building in this virtual world. And people are interested because you can still think about making money off it if the metaverse really innovate and a lot of people adopt it. You can lease out virtual space, and you can have Target in the virtual world, and people, instead of surfing the internet, they go in their virtual world and they go shopping at Target, and they can see things. I don't know how to envision that, but so there's a lot of innovation going on. Sometimes it's scary because it's maybe being from the older generation, it's hard to grasp. But it's
fascinating was the word I was going to use. The pace is increasing, which makes it scary for me too, as a child of the 80s. But what you're saying is you enter the metaverse through your virtual reality goggles, and if you need a roll of paper towels in the physical universe, you put on your goggles, walk down the aisle at Target, pick the stuff off the shelves that you need, and then Target can deliver that to your front door in the physical. It's fascinating how this stuff is going to evolve over the next decade.
And Zoom, things like that will be probably in the metaverse. So rather than being two-dimensional like we are now, it's going to be three-dimensional. And those are things from a technological standpoint, I think will be fascinating to see. I mean, you always, if you have a Zoom meeting or a meeting, a virtual meeting with more than one person, it's really hard to talk all at the same time. And sometimes it's kind of frustrating, right?
Yeah.
But that's because you need a 3D world where, if you're closer to me in the 3D world, then I can hear you. I cannot hear as much as what other people are saying unless I'm actually close to you, right? So these are all applications that I think will change the way we do business, change the way as academics will maybe teach a classroom.
Mm-hmm.
It will be probably more engaging. So that's probably a good thing. But at the same time, probably scary, right? For as every innovation has the dark side.
Yeah, I mean, and as someone that who didn't grow up with this kind of stuff, you hear about Facebook creating the metaverse, and the immediate thought that pops into my head is people are going to get stuck in there. We're going to lose people to that if it's more enjoyable to be in the metaverse than it is to be in reality, and that scares the hell out of me.
That's exactly what I thought.
We're in the matrix, probably, at that
Exactly.
point.
That's exactly what I thought, and I don't know. We'll see. We'll see what happens in the future.
So let's bring it back a little bit. Update us on what institutions are doing with crypto, how institutions are allocating to it, and how they're thinking about it.
Mm-hmm. Well, you have a lot of hedge funds that are crypto hedge funds that are definitely, hopefully, making money trading cryptos. And if you look at the last 3 years, there's been a tremendous growth in assets under management for crypto hedge funds, right? So every month there's new crypto hedge funds being founded. Crypto venture capitals as well. That's something that's going on. For example, A16Z is one of the best, I guess, venture capital firm in the crypto space, and they invest a lot of money in new protocols that they believe they're gonna change the world, and the technology underlying those. And that's from the kind of creation side. Then investors like pension plans, some of them are thinking about adding crypto to their portfolio. Some have already done so. I forgot, I think it might have been a Texas retirement plan. Texas teachers, I forgot, but added 3 to 4% in crypto. Endowments, seems like some of them have added crypto to their portfolio.
Those are direct crypto holdings as opposed to a pension fund or an endowment investing in the hedge fund that you mentioned previously.
Well, it's hard to say because it's definitely undisclosed, right? But it could be through a vehicle such as an hedge fund. So you invest in a crypto hedge fund, and then you get your exposure to crypto.
Sure.
I don't think institutional investors do this directly.
Yeah.
But definitely through venture capitals, get exposure to crypto, and hedge funds, they get these exposure to crypto.
That makes sense. That makes a lot of sense to me, because there's always the risk of custody for these things, and that's as I understand it, the primary reason that we don't have an ETF out yet that holds Bitcoin directly. They're all based on the values of futures contracts, which is challenging for any long-term investor to hang on to long-term.
Right.
So that's interesting. So where do you think that pensions and endowments, what is the barrier to a pension or an endowment fund? Will they be able to hold them directly once we have some more regulation?
I think they'll always go through a vehicle like a hedge fund. So, I mean, endowments and pensions, they got this long-term view. They don't really care about volatility, right? So they can actually enter the market through this vehicle. They might have connections to the best people. Think about MIT, Stanford, Harvard, Yale. They might have connections to the best crypto hedge fund managers out there. They get a small exposure to crypto, but at least they can ride some of that. Hoping for that to be uncorrelated, and especially in the world of very low real returns going forward. In the next 10 years, it seems like real return U.S. equities, they're going to be low. So how you juice your returns, right? It's private equity, it's venture capital, it's probably crypto has some place in a portfolio.
Right. So your research that you're engaged, you're spending most of your time you're spending most of your time at work researching different things, getting papers published. You spend some of the time teaching. What are you studying now? And I have a follow-up to that, but let's maybe start there if that's okay.
Mm-hmm. Yeah, no. So I teach investments. So that's the class I teach is an undergraduate class. My research is mostly in the area of investments, and mostly in the area of big institutional investors such as endowments and foundations. So most of my papers are on university endowments, that support the mission of the nonprofit. So every year, 4 to 5% of the endowment market value is spent on the university, so to support the budget. And in my research, I try to understand what drives their return, what drives their asset allocation decision, the role of governance, so the role of the board of trustees in shaping asset allocation decisions, the role of networks. As I was mentioning here, I have a paper on the role of networks to access the best venture capital managers or private equity managers. And it seems like some endowments can do that. That's where they get most of their return over the last 20 years. It's because of access to closed but highly sought investment vehicles. And some of my research also focuses on foundations, so private foundations and their role in society and how they kind of spend their money and their relationship, the link between spending and asset allocation decisions. So that's where I'm at.
Where do you expect to take it over the next couple of years?
Well, I'm in the process of publishing these papers, so hopefully it's a very long process. From idea generation to publishing a paper, it can take from 2 to 4 years. So that's kind of a long process. You go to conferences, you present, you discuss, you get feedbacks, you redraft the paper, do more analysis, submit, get rejected, submit again, change the paper, work for another year on the paper. So it's kind of sometimes a little frustrating, but I love it. So it's good. It's I don't feel the pain when I work on my research. It's enjoyable most of the time.
I'm glad to hear that, because it sounds like a heck of a lot of pain to go through that kind of process for
It is
getting published.
It is, but it's I love the flexibility to think about what I like, to be creative and think about my topics that I'm interested in. And that's, I think, the beauty of academia, right? And being able to do what you like and try to push the knowledge forward a little bit.
Yeah. And I'm thinking through the timeline here. It sounds like you became interested in crypto a little bit more recently and had probably already started down the path of studying the endowments and foundations and everything that you just described to us. Do you have any plans to study cryptocurrencies and decentralized finance more formally in the future?
Yeah, no, I do. It's this. I'd like to study crypto in the context of portfolios. I know there's data out there on crypto hedge funds, so that's probably an interesting avenue to understand how this vehicle works, how they perform, whether it makes sense to add it to portfolios, the role of human capital. I think it's interesting because you probably see a completely orthogonal set of skills that are needed to manage those investments. So maybe it's not traditional finance, but it's more tech.
Right.
So those are all interesting questions. Obviously, there's a lot of research going on within finance academia using blockchain data to understand, for example, illegal activity, and how that feeds into the real economy and how that kind of circumvent regulation and that through the blockchain. Also, whether Bitcoin is really decentralized, because if you look at who runs the nodes and all that pool, is it really decentralized when it's the 5 biggest pool owns 95% of the validation process, or there are 5 whales, so the 5 biggest account owns 99% of Bitcoin.
Right.
So these are all interesting things to think about.
Yeah, absolutely. It's a new frontier, and for me as a professional planner and investment advisor and investment manager, I have a very hard time allocating to crypto without some hard data and research performed by people smarter than me that I can really trust, that has gone through peer review and the scientific method and gone through that rigorous process you're going through right now for your endowment papers. And so I look forward to the day when we have a little bit more hard data to use to make some of these investment decisions, because it is a treacherous thing to walk out on without that.
Yeah, I agree. There's a lot of. I think my suggestion is there's a lot of things you can research yourself in the crypto space, because everything is kind of public, right? That's the point of the decentralization, that you can go and look up anything you want on the blockchain if you really want to understand what's going on. So I think that will give power back to people like us, right? That we don't have access to the most up-to-date research or trading softwares or whatever.
That's a great point, and support for your comment earlier about the new skills to be able to manage and evaluate this stuff is going to be a combination of tech and financial skills, and that's a great example.
Yeah, I'm not saying everybody should be able to code those things, right? You don't have to be like a software engineer, but I think understanding a little bit of tech and technology, computer science is helpful. Cryptography is a big branch that I'm really fascinated, and finance. You got to know a little bit of finance as well.
That's right. Well, we've covered a lot of ground today, Matteo. What have we missed from your perspective? What do investors, what do business owners need to know about decentralized finance that we haven't talked about already?
I would say the risks. We haven't talked about risks a lot today, but there's a lot of risks in DeFi and decentralized finance and blockchain, which are hidden. There's the smart contract risk, right? We talked about smart contract. There can still be logical error in those smart contracts, and then you can lose your money. There's hacks, we hear about hacks every week, and when the money is hacked on a blockchain, it's really, really hard to get it back. And then I would say the regulation is something that we need to keep in mind, because of the SEC, IRS, the know your customer, all those things will play a big role in crypto. And then I think we need to think about environmental risk as well, right? Because we've been hearing a lot about Bitcoin being not so environmentally friendly. And, from people like us of our generation, and maybe even the younger generation, it's something you really need to think about when you make some investment decisions.
Right. Yeah, absolutely. Well, I want to be respectful of your time today, but thank you again for coming on. This has been really educational to me, and I think a lot of our listeners, and I'd love for you to come back on in the future as your research progresses and as this space continues to evolve.
I would love to. Thank you, Grant.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.